In today's video, I want to talk to you guys about a dividend king. What the And what that means is that this company has not only paid dividends for the past 50 straight years, but has actually increased them every single year, even through market crashes and recessions. And when looking at this stock in particular, it's actually down close to 40% from their highs, which leaves it with a dividend yield that is still very high at over 3.5%, and they have a 5-year growth rate that is well into the double digits, which is very impressive considering that it's been growing that dividend for such a long time. So which stock am I talking about? Well, that happens to be 3M, ticker symbol MMM. So in today's video, I want to talk about that really nice dividend. I want to talk about why the stock has been crashing and where I think the company is headed in the future, and if I plan on buying the stock anytime soon. All of that and a lot more in today's video. I really hope you guys enjoy this. Let's get started. What's up everybody, my name is Ale and welcome to my world of stocks. Now when looking at the company, I find that the average retail investor isn't usually aware of the company, but when I start to tell them about some of 3M's products, then they are instantly reminded of who this company is. And that's because 3M is the company behind some of the world's most popular staple products like Post-it notes and Scotch tape, but they also offer a number of cleaning, safety, industrial, medical, automotive, and even electrical products as well. So even though I'd argue that their innovations haven't been as great as they have in the past, they do still remain pretty well diversified in their company in terms of the products that they offer across a variety of different markets. Now turning to their stock, at the time of this recording, they are literally trading at right about their 52-week low of $160 per share. And while they are technically still up by over 12% in the past 5 years, they've really seen some nasty drops since the start of last year, with these two in particular being quite devastating. So zooming in on that poor performance, we can see that they are actually down close to 40% from their highs that they saw a little over a year ago. And while they were originally having a great start to this year in 2019, the last couple of months have been disastrous as they have now dropped by well over 25% from their recent highs. Of course, this did lead to a better valuation as they now sport a forward PE ratio of just 15, but their 5-year PEG ratio is still pretty high at over 4.3, meaning that analysts used on Yahoo Finance expect 3M's growth to be pretty weak in the coming years, given that we typically want that ratio to be a lot closer to 1. Although to be fair, other sites like Simply Wall Street and Seeking Alpha have their PEGs closer to 2, so it really depends on what analyst you're looking at and how big of a time frame. In any case, when comparing their PE ratio to their previous levels, you can see that their current ratio is pretty close to the lowest levels that we've seen in the past 5 years, meaning that buying the stock right around these levels may be a decent value if the company can actually get their business moving in the right direction again, but we'll talk more about that in just a second. First, I want to quickly mention their dividend because I think it's one of the absolute best out there. This is a company that has paid a dividend for over 100 years, and not only have they grown them consistently every single year for the past 60 years, even through recessions and market crashes, but even after all of this growth, they are still growing them at a 16% 5-year growth rate and yielding over 3.5%. I personally love dividend stocks, and it's not that easy to get one with this massive amount of growth history that is still yielding a decent percentage at their current price with such a high 5-year growth rate. So to me, this is a company that if they can turn things around, then I would definitely be interested in picking up this stock. But of course, we all know that dividends don't mean much if the stock price continues to plummet. So let's now take a look at why the company has been struggling and why the stock has been getting destroyed by Wall Street. And in my opinion, that really has to do with 3 primary reasons. And one is the lack of innovation, another is weak growth and weak growth projections, and then number 3 would be the weakening Chinese economy. So let's quickly run through each of those. Now, if we take a look at their sales for the past 4 years, we can see that they haven't really grown by much, going from $30.3 billion in 2015 to $32.8 billion in 2018, which is only growth of about 8% in those 4 years, with last year's sales only growing by a little over 3%. Now, as far as profitability goes, they've still been positive by billions of dollars, but their net income has been a little up and down in recent history, and the performance hasn't been quite strong enough to really impress investors. And I think this weaker growth can be better visualized when looking at their last 8 quarters, as you can see that their last 3 quarters in particular have seen sales take a nosedive, with all 3 of them even dropping by year-over-year percentages. Their last quarter in particular even saw sales drop by as much as 5% year over year. Speaking of which, their latest earnings were so disappointing to investors that it caused the stock's biggest one-day drop since the 1987 market crash that we all know as Black Monday, where the Dow Jones dropped by over 22%. Now, looking a little closer at those results, we can see that Wall Street was expecting revenue of over $8 billion, but 3M missed those targets by over $160 million, which also helped them miss adjusted EPS targets of $2.43 per share, coming in at just $2.23 per share. They also lowered their guidance for the full year by over $1 of adjusted EPS, which is the second time that they've lowered that guidance this year. The poor results seem to mostly come from their industrial and electronics and energy segments, both of which dropped by nearly 3% in sales, while small gains in healthcare and consumer weren't really enough to pick up the slack. Perhaps more telling was the fact that their 2 largest geographical segments in the United States and Asia Pacific both saw organic local currency revenues decline, while Asia Pacific in particular, which happens to be the second largest for the company, saw their sales drop by as much as 3.6%, likely due to the weakening Chinese economy. In fact, I dug a little deeper and I found that their China business in particular was down over 4%. And again, this is just organic local currency growth, but overall, total sales actually dropped by as much as 7.4% in the Asia Pacific region. This weakness in China was talked about several times during their conference call, and for me personally, it's difficult to know if things will improve anytime soon, given that the Chinese economy continues to weaken as it has for the past decade, as you can see on this chart here that shows GDP annual growth rates. And if we zoom into the last few quarters, we can see that the rates have dropped to about 6.4%, while future estimates show that those rates are expected to get worse and worse as we head into 2020, where they're expected to break down lower than the 6% level. And the other concern, at least in the short term, is of course the entire trade war going on between the US and China that only seems to get worse every week. On the other hand, I do think that President Trump desperately needs a trade deal to be done by the next election, and clearly China needs it just as badly as he does, since the economy continues to sink, so it's not too crazy to assume that a deal could get done within months rather than years. And there's also the fact that China continues to push out new stimulus, so the 1-2 punch combo of a trade deal with new stimulus could help China improve quite a bit, but it remains a wait and see situation, although I do think that those would really help 3M in this particular situation. In the meantime, it appears to me that 3M is at least attempting to turn things around themselves, given that they're restructuring the business and unfortunately laying off 2,000 employees, which is about 2% of their workforce, in an effort to save around $250 million a year. On the other hand, that could also be seen as a negative, since cutting employees is usually a move you make when you expect things to get worse. But when it really comes down to it, 3M is the type of company that needs to continuously innovate with new and compelling products if they want to stay relevant in the market and maintain high margins with strong pricing power. And because of that, they continue to invest heavily in research and development, with the latest quarter seeing over 6.3% of their sales going towards research and development, which is consistent with how much they usually invest in R&D every single year. But they also saw another $400 million going towards capital expenditures, and while I have this slide up, I'll just quickly add that they returned $1.5 billion to shareholders in the form of dividends and share buybacks. In any case, all of the research and development helped them control over 100,000 patents in 2017, producing around 3,000 patents a year, with 46 technology platforms and labs in 36 different countries. But another method that 3M is experimenting with to spark future growth is large acquisitions. In 2017, they acquired Scott Safety for $2 billion, who makes all kinds of different safety and protective equipment. Earlier this year, they acquired M-Model for $1 billion, which specializes in health information systems. And most recently, they announced a record-breaking acquisition of Acelity for $6.7 billion, making it the biggest acquisition in 3M's history. The company is expected to be a great fit to 3M's healthcare business, as they specialize in wound dressings and other advanced technologies and products to stop bleeding. We'll have to see how this newest deal affects their balance sheet, but as it stands right now, I'd say that it looks good overall, but is nothing special. They currently sit on about $3 billion of cash, $14 billion in current assets, and $39 billion in total assets, with about $7 billion in current liabilities, $16 billion in long-term debt, and $29 billion in total liabilities, giving them a current ratio of 2 and a total ratio of 1.34. So again, pretty decent, but not anything too amazing. So in conclusion, I'd have to say that 3M clearly has a strong dedication to returning profits to shareholders in the form of some really nice dividends that I would definitely love to have myself for the long term. But also at these prices, the stock has been being down a lot, and they continue to repurchase their shares, which is hopefully something that they will continue. We'll have to see if maybe they take a pause in that because of the most recent acquisition. I think back when they acquired one of their other companies, I think they took a pause on share buybacks because they didn't want to cut the dividend, so they kind of took the money from share buybacks and used some of that to make the acquisition. So we might see a pause there, which is not really a good thing in my opinion, because right now the stock price is low and I'd like for them to be buying the stock right now. But we'll have to see if they kind of maneuver that and what how they go about doing that. In any case, this remains a company that has some of the most popular products in the world that I just can't imagine going out of business, and they continue to invest very heavily into research and development, and also they continue to make acquisitions. So I do think that they will have some success in the future. And by the way, I didn't have a chart on this, but if you take a look at their year-over-year growth rates, there's often times where 3M just kind of goes up and down, and right now they're kind of in the down cycle of it, so they could potentially have stronger results in the future, again, especially if we get a trade deal done with China, and if their Chinese stimulus helps their economy as well. I could definitely see an uptick in growth for 3M in the kind of medium term. So for those reasons, I actually am still bullish on 3M for the long term. I just think that they're going to continue to get hammered right now in the short term, because I don't see any progress being made with the trade war with China, and it looks like China's being kind of patient about this. I don't think they can be very patient for too long, because I think they do desperately need a trade deal just as much as we do. But in any case, I think short term I am kind of bearish on 3M. Medium term, I start to get much more bullish. Long term, it looks like a pretty reliable dividend stock. And especially if you're looking for some consistent dividend payments that continue to grow. Again, 5-year growth rate in the double digits, 3.5%, and this is a dividend king stock that has increased their dividends for 60 years. I believe they've paid dividends for like over 100 years, so they're very dedicated to paying out those dividends. But one last thing I want to mention is that I was reading an article that said that about 60% of their sales actually come from outside of the United States. And that's the thing that kind of worries me, because again, we're seeing weakness in Europe, some recessions there. We're seeing the whole Brexit situation. Again, China struggling. So macro global economic conditions don't look so good right now. But again, in the long term, I'd have to assume that sales would start to pick back up and things like that. So I'm just being very cautious and patient with this stock. It's not one that I'm buying right now, but if it continues to drop and maybe we get a trade deal done, it kind of bottoms out, we get a trade deal, that might be a very interesting time for me to maybe dip into this stock, maybe just kind of chip away at it a little by little and just turn it into a bigger position over time. But we'll see. I'll definitely give you guys an update video if I do decide to buy the stock, but it is definitely one that I find very interesting. Anyway, I hope that you enjoyed the video. Make sure you hit the like button if you enjoyed this, and subscribe if you haven't already. I'll catch you guys in the next one. Take care. Bye-bye.